Mutual and stock insurers often starts with a detail people overlook. Mutual versus stock insurance companies explained becomes clearer when a stock insurance company is owned by shareholders. Investors buy shares and expect the company to earn profit. Management must consider shareholder returns. Once the cause is named in mutual versus stock insurance companies explained, the response can fit the situation more closely. This is why investors buy shares and expect the company to earn profit deserves attention before the situation hardens into a pattern. Mutual and stock insurers becomes clearer in a concrete situation. In mutual versus stock insurance companies explained, notice when a mutual insurance company is owned by policyholders. Customers may have membership rights through their policies. The company is organized around serving insured members. The link between those pieces is what makes mutual versus stock insurance companies explained useful in real life. That makes the example useful because it shows the company is organized around serving insured members in a form someone could recognize. Mutual and stock insurers changes the decision before anyone names it. A familiar mutual versus stock insurance companies explained example is when ownership affects priorities. A stock insurer may focus strongly on growth and return on equity. A mutual insurer may emphasize long-term member stability. People often feel pressure around mutual versus stock insurance companies explained before they can explain where it came from. If this is ignored, a mutual insurer may emphasize long-term member stability can look sudden even when the setup was already present. Mutual and stock insurers has a cost that appears later. In mutual versus stock insurance companies explained, the real-world version may be that both types collect premiums and pay claims. The basic insurance function does not disappear. Risk pooling, underwriting, reserves, and claims handling remain central. This is the detail that changes what to check next in mutual versus stock insurance companies explained. Without that check, both types collect premiums and pay claims can be misunderstood or handled too late. Mutual and stock insurers depends on timing as much as facts. It shows up in small moments, such as when mutual companies may pay dividends to policyholders. Dividends are not guaranteed and depend on performance. The money reflects favorable results after costs and claims. Noticing that driver early can keep mutual versus stock insurance companies explained from becoming harder to manage. This is why dividends are not guaranteed and depend on performance deserves attention before the situation hardens into a pattern. Mutual and stock insurers can look simple from outside. Look at a case where stock companies can raise capital through markets. Selling shares may help fund expansion or absorb shocks. Access to investor capital can support growth. The headline alone does not show the whole chain behind mutual versus stock insurance companies explained. That makes the example useful because it shows access to investor capital can support growth in a form someone could recognize. Mutual and stock insurers creates pressure in ordinary life. A concrete version is when mutual companies may focus on policyholder loyalty. Long-term relationships can matter because customers are members. Stability may be valued over rapid expansion. The background force should guide the next decision in mutual versus stock insurance companies explained more than the first reaction. If this is ignored, stability may be valued over rapid expansion can look sudden even when the setup was already present. Mutual and stock insurers is shaped by rules and incentives. In a normal day, pricing can differ but structure is not everything. A mutual insurer is not automatically cheaper and a stock insurer is not automatically worse. Claims history, expenses, competition, and risk selection all affect premiums. In mutual versus stock insurance companies explained, the clearer reading follows the cause instead of stopping at the visible result. Without that check, pricing can differ but structure is not everything can be misunderstood or handled too late. Mutual and stock insurers becomes risky when assumptions replace evidence. Picture the situation where governance differs. Stock shareholders vote through shares while mutual policyholders may have voting rights. Control follows ownership rules. The moment becomes easier to handle when the moving part is named clearly in mutual versus stock insurance companies explained. This is why stock shareholders vote through shares while mutual policyholders may have voting rights deserves attention before the situation hardens into a pattern. Mutual and stock insurers is easier to handle when the moving parts are visible. The clearest version is when demutualization can change structure. A mutual company may convert into a stock company under certain rules. Policyholders may receive compensation or shares. That mechanism explains why the topic affects real choices in mutual versus stock insurance companies explained. That makes the example useful because it shows policyholders may receive compensation or shares in a form someone could recognize. Mutual and stock insurers has both a visible side and a quieter side. In mutual versus stock insurance companies explained, someone may notice that regulation applies to both. Insurance departments monitor solvency, reserves, and market conduct. Ownership does not remove public oversight. Seeing the cause early gives people more room to respond well in mutual versus stock insurance companies explained. If this is ignored, ownership does not remove public oversight can look sudden even when the setup was already present. Mutual and stock insurers can turn small choices into larger consequences. Watch what happens when claims handling should be judged directly. Company type does not guarantee a smooth claim. Adjuster quality, policy wording, and documentation matter. In mutual versus stock insurance companies explained, the visible event can distract from the driver that needs attention. Without that check, claims handling should be judged directly can be misunderstood or handled too late. Mutual and stock insurers rewards preparation more than guessing. Mutual versus stock insurance companies explained becomes concrete when life insurance has many mutual examples. Long-term policies make stability important. Policyholders may care about dividends, guarantees, and financial strength. When mutual versus stock insurance companies explained appears in real life, this is the detail to check first. This is why long-term policies make stability important deserves attention before the situation hardens into a pattern. Mutual and stock insurers can be misunderstood when people focus on one number. For example, stock insurers may offer broad product lines. Large public insurers can operate across many markets. Scale may bring technology and distribution advantages. In mutual versus stock insurance companies explained, this is the point where the visible choice and the real pressure start to meet. That makes the example useful because it shows scale may bring technology and distribution advantages in a form someone could recognize. Mutual and stock insurers affects trust because expectations are involved. In real life, mutual insurers still need surplus. They must hold enough capital to pay future claims. Member ownership does not mean premiums equal claims dollar for dollar. That is why mutual versus stock insurance companies explained should be read through facts rather than a quick assumption. If this is ignored, member ownership does not mean premiums equal claims dollar for dollar can look sudden even when the setup was already present. Mutual and stock insurers works differently for different people. Think about how profit is not a dirty word in insurance. Even mutuals need positive results to remain strong. Losses can threaten claims paying ability. For mutual versus stock insurance companies explained, the important move is to notice the chain from first signal to final effect. Without that check, profit is not a dirty word in insurance can be misunderstood or handled too late. Mutual and stock insurers should be checked before money or emotion is committed. A simple mutual versus stock insurance companies explained case is this. Customers should ask what ownership changes for them. Dividends, voting rights, service model, and long-term stability may matter. The answer varies by product and company. That sequence explains why mutual versus stock insurance companies explained can grow even when the first moment looks small. This is why dividends, voting rights, service model, and long-term stability may matter deserves attention before the situation hardens into a pattern. Mutual and stock insurers becomes easier to manage when records are clear. Mutual versus stock insurance companies explained appears when agents may represent either type. Distribution can hide ownership from the buyer. Asking directly can clarify who owns the insurer. The early sign matters in mutual versus stock insurance companies explained because it can change cost, trust, timing, or emotional meaning. That makes the example useful because it shows asking directly can clarify who owns the insurer in a form someone could recognize. Mutual and stock insurers requires a specific next step rather than a vague hope. One ordinary mutual versus stock insurance company's explained version is that financial strength matters more than the label. An insurer must be able to pay claims years later. Ratings, reserves, and track record deserve attention. The pattern in mutual versus stock insurance companies explained is easier to handle when the first signal is noticed instead of dismissed. If this is ignored, ratings, reserves, and track record deserve attention can look sudden even when the setup was already present. Mutual and stock insurers matters because the result is felt in daily life. Consider the moment when mutual and stock insurers are two ownership models for the same basic promise. One centers policyholder ownership and the other shareholder ownership. A smart buyer compares price, coverage, service, strength, and claims reputation instead of assuming one model is always better. The answer in mutual versus stock insurance companies explained is usually found in the cause, not in the label people attach afterward. Without that check, mutual and stock insurers are two ownership models for the same basic promise can be misunderstood or handled too late.